No one would ever think that the most indebted country in the world would be Japan. But yep, the Asian country with a population of 127,185,332 has the highest debt in the world, at 234.18% of its GDP. Japan's debt currently sits at 1,028 trillion yen, 9,087 trillion US dollars. From 2001, the Bank of Japan introduced quantitative easing to flood the economy with liquidity, revitalizing commercial banks by swapping their bad loans for state-issued bonds. But this resulted in the government's debt rising. When the 2008 crisis hit, the Bank of Japan just kept rolling with its liquidity plan, and therefore the debt got even higher. Japan's national government debt reached 10,221.5 billion USD in February 2020. Japan's economic freedom score is 73.3, making its economy the 30th freest within the 2020 index. After the stock exchange crashed in Japan, the government bailed out banks and insurance companies and provided them with low-interest credit. Banking institutions had to be consolidated and nationalized after a period of time, and other fiscal stimulus initiatives were rolled out to help reboot the struggling economy. Unfortunately, these actions caused Japan's debt level to skyrocket. Furthermore, debt as a percentage of GDP has increased due to various spending increases to beat the recession. Construction pork barreling, which failed due to the economic deflation. The country even reported negative GDP growth as compared to the previous year in 2011 and in 2014. With one of the most impressive gross domestic products, between 2010 and 2013, the percentage in Japan decreased by approximately 1/100th, and it's expected to drop even lower in subsequent years. But before all this chaos, Japan's economy was the envy of the world, before succumbing to at least one of the longest-running economic crises in financial history that might come to be referred to as the lost decade. In the 1970s, Japan produced the world's second-largest gross national product, GNP, after the US, and by the late 1980s, ranked first in GNP per capita worldwide. But all of that led to the 1990s, when its economy just collapsed without any explanation. So the question is, what caused Japan's lost decade? Most economic crises immediately follow an economic boom, where valuations disconnect from reality. For instance, the dot-com bubble. Similarly, Japan's lost decade was largely caused by speculation during a boom cycle. Record low interest rates fueled stock exchange and land speculation that sent valuations soaring throughout the 1980s. Property and public company valuations almost tripled, where 3 square meters near the Imperial Palace was sold for $600,000. Yep, any time from the past was better. Upon realizing that the bubble was unsustainable, Japan's finance ministry raised interest rates to undertake and stem the speculation. This move quickly led to a stock exchange crash and debt crisis, as borrowers did not make payments on many debts that were backed by speculative assets. Finally, the problems manifested themselves during a banking crisis that led to consolidation and a number of other government bailouts. Following the crisis, the situation was every man for himself, as many Japanese citizens responded by saving more and spending less, which had a negative impact on aggregate demand. This contributed to deflationary pressures that encouraged consumers to further hoard money, which resulted in a deflationary spiral. The economic environment that the Japanese stoked in the 1980s is often seen being repeated in oversupplied property markets in emerging economies like China and Brazil. When the property crash came, the nation's banks were left insolvent, carrying overvalued loans on their books that were backed by properties that kept falling in value. This overhang of non-performing loans prevented banks from lending to new enterprises and effectively stopped the economy in its tracks. The question that comes to mind is, how long can Japan keep funding such massive deficits?